Broadcast is now starting. All attendees are in listen-only mode.
All right, good morning, everybody, and thank you all for joining us today, Thursday, July 19th, at Investor Inspiration. I do appreciate everyone for coming out today, and I hope you guys enjoy all of today's presentations. I do want to make sure everything is working properly first, so if you can hear me and see my slide on the screen, can you please just let me know, type in yes or Y in the questions box. All right, thank you everybody who's responded. I do appreciate that. And make sure that you do know where that questions box is. It is on the GoToWebinar control panel. Today's presenters may have some questions for you, or if you have questions for them, that's where you will put them. And they do appreciate it when you ask lots of questions and answer theirs and interact with them. It makes it a lot more fun and enjoyable for everyone. So make sure you guys know where that is. All right, and also make sure that you do have a pen and paper available. We have 6 presenters for you today, so you'll be getting a lot of information. So I'm sure you'll have a few things you'll want to write down to remember. And we will begin in just about 4 minutes with our first presenter for the day. That's Chris Kimble, and he's the founder and CEO of Kimble Charting Solutions, a premier chart technician whose expertise are sought after by other individual investors and financial professionals worldwide. Chris produces one-of-a-kind, big-picture chart patterns to highlight extremes in price and to identify reversal and breakout opportunities. Top bottoms, no middles is his objective. Greater confidence and improved entry and exit decisions are goals for his clients. Chris has coined phrases like power of the pattern, Eiffel Tower pattern, and moda points to emphasize the importance and impact of chart pattern analysis to the investment decision. An Occam's razor fan, he believes that investors can often reduce the investment decision down to an asset's price and pattern. Chris applies chart pattern analysis to equity and bond indexes, currencies, commodities, sectors, and select individual stocks. He often includes an image inside his charts to highlight the theme of the pattern and add a touch of humor and make charts more memorable. He has 38 years in the financial services industry, many of those years as a personal financial planner, before turning to help people as a chart technician. His work can be found on StockTwits.com, Yahoo Finance, Zero Hedge, Investing.com, and See It Market. His work has also been featured on MarketWatch, Bloomberg, and CNBC. All right, so we will get Chris's screen all set up, so please give him a warm welcome, and I hope you enjoy all of today's presentations.
Thank you, Renee. Can you see my screen?
Yes, I can see your screen and I can hear you loud and clear. If everyone in the audience can just let us know and confirm that you can see and hear him as well, that'd be great. And then we should be all set to begin.
Thank you, Renee, for arranging this. Nobody does it any better than you do. And I know you got a really big day ahead of time, and we're honored and humbled to be part of today. I brought my Italian voice today. I apologize. I've got a little bit of a cold. So if I hack a few times during the presentation, I apologize, ahead of time. So please forgive me. So because this is recorded, we're going to try to go fairly quickly, cover a lot of material. We know that you're very busy, everyone that's on the recording, so we appreciate the chance to discuss how to find opportunities in a flat market, and also why we believe that multi-decade opportunities are sitting right in front of us, and how to take advantage of them. So when I finish, Rick is going to take over. He's going to talk and share a special offer to the first 62 people that can take advantage of it. And also he'll discuss on how to stay current with our research. And as in today's world, we all know that we all have disclaimers. So before we get going, here's our disclaimer. So today, what are we going to talk about? I'm going to start off the first third of the presentation discussing a big picture charting opportunities. We're going to drill down to what's maybe one of the major influences to why the market has been choppy for the last 6 months. And then I'm going to share 15 different trading ideas towards the end that have a chart pattern probability of a upside breakout 2/3 of the time, or in other words, about 65% of the times these patterns break out to the upside. And the thing that I like about these that you'll see is also the risk management is really tight and precise. So we believe there's some really good opportunities, out there. So just as a reminder, the name of our company is not Kimble Charting Problems. It's easy to turn on the news and see people discussing all the issues of the world. What I really believe in is, and what I name the company is Kimble Charting Solutions. So today you're going to hear and see chart pattern analysis and what we believe are solutions to these really fun and exciting patterns that are taking place. This, as Renee said earlier, this is my 38th year in the business. We've all seen tons of changes in my near 40 years in the business. There's a lot of resources and opinions. I do believe that a lot of this causes extra noise, and it can make it so difficult for people to make some quality decisions. So I believe that we should boil it down to the power of the pattern. Patterns represent all known knowledge on the planet to billions of men and women that are involved in the marketplace. Oftentimes, a lot of people think there's a lot of secrets going on, but I think for the most part, the excess information is built into price, and that's what matters. So price and pattern determines the action that we take. As an example, here of this asset sitting on support, this is of interest to us as an entry point. We look for high probability patterns. Our favorite patterns are the bullish ascending triangles and the bullish falling wedge, which historically, regardless of asset class of commodities, bonds, stocks, and ETFs, have a 2/3 probability of upside breakouts. And they also provide really nice risk management, tools. And to me, that's the biggest thing is, a lot of people say, well, Chris, what's the upside to all of this? And to me, the first thing is how do we manage risk itself? Because if we lose, which is going to happen, I've never met even my mentor that we'll discuss in a little bit, Sir John Templeton. He couldn't figure out how to be right more than 2/3 of the time. He just found out when he was right, he could really be right. But mistakes are going to be made, and so this is the key, is to draw that line in the sand and know when you want to walk away and have great risk management tools. And also another thing about us is we're not afraid to take profits as the trends and these patterns break out, to the upside that we really believe does happen and will happen so many different times. So one of the things that we want to remind people of is we're not bullish or bearish. We are bullish on one thing. We're bullish on opportunities, and we're bullish on solutions. From John book, very popular because you valuable. I the crowded trade uh, first, particularly one of the best track records of all time. I mean, one thing that impressed me is the job of being 5 to the 1980s. Yeah, 15% a year during that flat market. And so he presented years was of today. It has since me would struggle of the American households. In the mid house, their assets on that year nowhere in 1962. But business for the average box, and as I got my securities license, be really difficult to stocks, understandably, but up almost 18 years when Sir John said it's going to strike. One of his reasoning was in the 90s, the peak financial assets of American households were in the stock market, and he was a very crowded.
We're having some issues with your audio. It keeps cutting in and out.
Peak, and then here's 2007, there's 2009, and now other part of the 19, the stock is at the second highest number of all time. So first time since then that is another thing that Sir John was influenced him in saying that the people have on margin short-term advisor perspectives, and the blue line is the margin, is the S&P 500, excuse me, and the red line is inverted spread. The margin debt is large. That's really not too so much focus, and it starts contracting. So you'll notice large in 2007 started contracting. That the spread between the two is than it was 2007. It's not that contraction. You know, at this time, it's comfortable to think that buy and hold would work. Just to be in the market, and it was a representation sentiment, and that's why the actual delusions I believe is really valuable. Sir John is known as this great fundamentalist, which he was also, I think, even much the best business-wise. It wasn't a business book, it was about psychology, and that's what fascinates me with the charts. It's nothing more than just a big psychological picture. So I believe multi-decade opportunities are in play, and we're going to discuss a little bit of how to take advantage of them. So we're going to start out with the big picture. And so we're just kind of skip around in some different asset classes. But now here's a long-term chart of the Thomson Reuters Equal Weighted Commodity Index. So over the past couple of decades in rising channel 1, the commodities have spent the majority of 20 years inside this rising channel. Now, over the last 7 years, since it hit the top of it in 2011, up here at the upper two, commodities have continued to create a series of lower highs and lower lows. So from a multi-decade rare situation, commodities right now at 4 are attempting to break down of a 20-year rising channel. And so as we all know, what commodities do can send important macro messages. What can influence commodities in many ways? Now we're going to look at a couple of decade chart on the US dollar on the top and the euro at the bottom. And you'll notice from a technical analysis situation, at the beginning of this year, the US dollar has been fading and the euro had been rising, but they were both facing clusters of differences. The US dollar was facing a cluster of support early this year here, and the euro was facing a cluster of resistance. So the 12-month trend, which was lower in the dollar and higher in the euro, stopped on a dime. And now for the last few months, the US King dollar has been pushing higher and the euro has been falling in price. So both are testing really important breakouts. So what the US dollar of King dollar breaks out above and the euro breaks down below, that would be a confirmation message of the prior chart of commodities breaking a 20-year support channel. So again, major long-term trend shifts could be in play. This is a chart of Doc Copper. Copper is often known to give good macro global implications signals. I wouldn't say it's necessarily a great one for the stock market itself, but in the longer trend, copper has continued to create a series of lower highs and lower lows. In 2016, we've seen this strong counter trend rally in Doc Copper. It hit dual resistance here just a few weeks ago. This is a weekly chart, and then you can see selling pressure has really ramped up, and Doc Copper has now broke below the 2018 trading range support and is heading lower. So the next support line in Doc Copper comes in around the 247 level. So again, if Doc Copper continues weak, that's a confirmation signal of the commodity break of a 20-year rising channel. So any of you that are interested in currencies and metals, this one really intrigues me because again, we have now a multi-decade chart we're looking at. This is the US dollar to gold ratio on a monthly basis. The ratio has continued to create a series of lower highs and lower lows inside falling channel 1. But since it hit support here in 2011, now the ratio has created a series of higher lows and higher highs inside rising channel 1, reflecting that the dollar is stronger than gold. So this is a monthly chart, which is reflecting that this month that the US dollar ratio is attempting to break out of a 20-year falling channel. So continued strength in this ratio sends a negative signal to the metals complex. And speaking of the metals complex, this is silver over the last 7 years. Descending triangle patterns, which are characterized by flat bottoms and falling highs. Roughly 2/3 of the time, they break down to the downside. And one of the nice parts about these patterns is you can take the height of the descending triangle and create what's called a measured move. So you can see if you took that measured move and applied it to the breakdown of support in 2013, it suggested that silver would at least decline to the $15 range. And it did more than that. It declined more than 35%. So it took a couple of years to make this pattern. And then once support broke, it continued to see selling take place. So now over the last 2 years, it appears that we have another bearish descending triangle pattern taking place with silver testing support. If silver would break support here, the measured move would suggest a decline to around the $11 range, which would be another 35% decline. So a really key support test is taking place for silver, with the prior charts in the dollar gold breaking out and the commodities breaking down. This would increase the odds that silver will struggle to hold at the bottom of this bearish descending pattern. Now switching to continued multi-decade patterns, but this would be in the Dow. The Dow has spent the majority of the past 70 years inside this blue shaded rising channel. You can see it started creating its higher lows in the 1940s. This is when I got into the business in 1982. This is when Sir John went on Wall Street Week and said, I don't think we'll ever see these prices again. So what we did was we just took these multi-decade rising support line, and I did a parallel copy paste, everyone, and laid it on the high in 1929. Lo and behold, the 2000 high hit the top of this channel, and then that's when it struggled. The 2007 market didn't make it back to there and then struggled, and now it's back at the top of the 70-year channel. So the trend, without any doubt, remains up, and nothing this year has broken that trend. The last 6 months of flatness has not broken it. The most positive thing that could take place for the Dow is to punch out to the upside. That would send a long-term message. The one thing I do want to make you aware of that you've probably seen, the top is monthly momentum, and you can see that it's very elevated and starting to roll over just a little bit. But what gets my attention the most is that the monthly momentum is as high as it was in 2007, in 2000, in 1987, and in 1929. So momentum levels are particularly high, and this is where bulls would not want to see selling pressure take place as it's kissing the underside of the long-term channel. One of the things I fell in love with in the late 90s was junk bonds. This is the top chart, everyone, represents the PIMCO Junk Bond Fund, PHDAX, with dividends stripped out. So it's just looking at a pure net asset value play. The thing that got me is we started seeing a divergence in junk bonds. To me, they represent the weaker part of society, the weak bond notes. And you can see that there was a 2-year divergence. I've always felt like since then, or I would question, would we ever see a divergence that big again? And we have not. But one thing that did take place in 2007 highs was a 7-month divergence in junk bonds. So each time the divergence had taken place and this rising support line broke in 2000, selling pressure ramped up. In 2007, selling pressure ramped up when this support line broke. And so now we see the second longest divergence in multi-decades in junk bonds, which has now been taking place for nearly a year. So with market depth where it is, the percentage of assets being very lofty in the financial sector, this becomes to me a really, really important support line, which is drawn off the 2009 lows at 1. So buy and hold and traders to me would get an important message if this long-term 9-year support line would break because of the 11-month divergence that's taking place. So quickly looking back on the bank index, I believe the banks are really important. When we think about the 2007 highs, the label that comes to mind is the financial crisis, and the financial crisis probably got its name from the struggles of banks and just the broker-dealer community, the capital markets, how much they struggled at the time. But this is just a close-up look of the waterfall pattern in 2007 in the bank stocks, where the bank index, which is the BKX, fell over 80%. But it all started with a descending triangle pattern similar to what we looked at in silver earlier. So once it broke support, it kept kissing the underside, and then when selling or buying pressure could not push it back above tool resistance, then selling pressure really took place. I humbly don't feel we'll ever see anything that dramatic again, but I do want to look back now on a long-term chart. This is well over a decade. So this is the pattern that we just highlighted in 2007. There was that descending triangle. So after the meltdown in banks, and they've continued, the trend is up, and they've continued up and up and up. They've now made it back to the 2007 highs. So they hit the 2007 highs earlier this year at the beginning of 2018. And since then, banks have been weaker than the S&P and could be creating another descending triangle just underneath the 2007 financial crisis highs. So for whether you're long-term, intermediate, or short-term trading, this falling resistance test is a really big one for the banks. And I think just stepping back and looking at the big picture here, This is a highly important picture that you want to see. Bulls in the stock market want to see banks either keeping up or exceeding the S&P, not a breakdown of the bottom of support. Another leading index that is facing, to me, a long-term breakout test is the semiconductor index. We all know that FANG stocks have done really well over the last few years. In hindsight, for all of us, a great place would have been to buy SMH or the semiconductors in 2009, as they have beat the S&P, they beat small caps, and they beat the NASDAQ 100. So the strong rally since the 2009 lows has semiconductors now continuing to test the highs that took place in 2000. So this is a monthly chart, so you see a lot of choppiness. This is the last month in the red. You can see twice in the last 5 months, the market has attempted to break out only to see sellers come in and create reversal patterns, monthly reversal patterns. So momentum is very high. So one of the most bullish messages that we could get is to see leadership break out above the 2000 highs. One of the greater concerning messages that market participants could get is if SMH would happen to not be able to get above the 2000 highs and would happen to roll over. So again, we're looking at almost a multi-decade pattern at hand that, to me, is going to be highly influential to our positioning going forward for long, intermediate, and short-term traders. So now we'll move away from some of the multi-decade charts, and we'll look at maybe why has the market been flat for the last 6 months. So this is a chart of the Dow on a monthly basis, just looking back over the last 9 years. And what we did is we applied Fibonacci to the monthly closing high. And again, the key word is the monthly closing high in 2007 and the monthly closing high in 2009. And then we looked at the 161 extension, or in other words, 61% gain of this lighter blue shaded area, which put the Dow at the 161 level around 18,000, just rounded up to 200. So you'll notice that a strong rally when it broke above 2007 highs, it pushed up, and then once it got to the 161 level, the sideways chop action took place. Does anybody know how long that sideways action lasted? Well, it lasted just short of 2 years, as it kept knocking on the underside door of the 161 level. This was the 800-pound gorilla. Then when it got above it from ideal price action, it broke above and then came back to test old resistance that had been resistance for almost 2 years as new support. And then what happened after that? A beautiful breakout took place. The Dow rallied 50% in just a matter of months. And so this ended up being an upper level base that took almost 2 years to form. And then once a breakout took place, then buyers, rushed in. So is something similar to this action at the 161 level influencing prices today? And I really believe it is. So let's stick with the same highs, 2007 highs and 2009 lows, and now you apply the 261 level. So in January of this year, as the market was screaming higher, as it broke above this 161 chop, it hit the 261, and now it's just went sideways for months. And when this was being hit, we shared with our members back in January that, hey, this is the 800-pound gorilla, and the strategy for the next several months, mentally and on paper, would be to accept that we're probably going to be in a lot of choppy action. Positions would only be most influenced trade-wise on short-term bases. You want to take small trades and don't expect much from the market as this sideways action takes place. So the key resistance is 285 on the upside and 253 on the downside. The prior slides, we showed that when the 161 level was hit, it took 20 months to rectify getting above that. I humbly would be very, very surprised if it takes that long to rectify this price pattern. So just real quickly, the Dow's doing the same thing. It hit the 261 price level in January, and it's created its sideways chop. So support for the Dow is 23.3, resistance is 26.7. And so I would not be surprised to see this go on for a few months. And so I think it's really powerful and empowering everyone to know this could be a big influence to why this market's going sideways. After it hit the 261 level, the positive from a bullish case is it hadn't fallen apart. It's just started chopping sideways. But it's been frustrating to a lot of people, I suspect, that weren't aware of this. But I would suspect too that we're going to see this take a while to resolve itself. This was from the Leasehold Group that I thought was interesting. For when the January high took place, you'll notice it took place across the board. This is the S&P, the Dow Jones 65 composite, transports struggled, utilities. The ones that haven't struggled is the Russells made a higher high, banks have made a lower high, 500 cyclical index lower high, the RSP, the S&P equal weighted a lower high, and the advanced decline line a higher high. So the two really positive aspects of this are the Russell small caps breaking out and the advanced decline line. All of the others are struggling. So this isn't a surprise because of the 261 extension levels. And if we can get above the 261 extension levels, it's really positive. So I thought this was interesting from Sentiment Trader. This looks like stock market volatility, bond volatility, and global FX volume volatility. And you'll notice that here was the big ramp up when everyone got scared in February when the S&P declined 9% just in a couple of weeks. But you'll notice that as they made the comment, all three measures of asset volatility are nearing their lowest levels in the past 3 and 25 years, actually. So you'll notice that when these tend to be really low and then people are being bored, laissez-faire, then volatility tends to pick up. So I wouldn't be surprised when we see volatility this low that we're going to see kind of some popular delusions that we're going to see a switch of that. One of the most positive aspects of this market is the continued advancement of the advanced decline line. This is the New York Stock Exchange advanced decline line weekly with common stocks only. It strips out any ETFs and zero coupon, or excuse me, any bond funds, closed-end bond funds. And you can see the trend solidly higher. So this would indicate that the odds are is that the trading range will probably resolve itself much sooner. This is the price action that took place when the market traded sideways for almost 20 months. You can see it hit support and then a blast off has taken place. So this is continuing to send a positive message to the overall market. Long-term participants in long positions, I think, would only get a concerning message if we'd see a support break in this zone. One of the things that I think our members found it kind of hard to believe is when we said that when the 161 level is taken out to the upside, that was around 17,000, but then the projection was for the Dow to make it to 26,000. So this could be another hard one to believe, but if from a long side perspective, it'd be very nice gain wise. If we take the same Fibonacci and apply it to the 2007 highs and 2009 lows, that the 361 level comes into play in the Dow at 34,400. So if someday this sideways chop is going to end, if it ends to the upside, don't be surprised to see some really nice movement, especially the longer that it takes in the sideways chop. So keep this in the back of your mind that if the 261 level could be taken out, Dow 34,000 would be Uncle Fibonacci's 361 extension level. So I'm going to go through some charts fairly quickly and wrapping up here, but we're going to share with you before Rick comes on 15 different trading ideas that have a 65% probability of upside move. So for those of you that like assets that are in upward trends and are near all-time highs, this would be of interest to you because an ascending triangle would looks like this. You'll see the long-term trend is up. It continually bangs above resistance. If a breakout takes place, you can measure the height of it, and then here's your measured move target. So this will be recorded. If you have a piece of paper, I'm going to fly through several of these opportunities. And then at the end, if you want to get the PowerPoint presentation or you want to get the list from us, you can email us or give Rick a call. But we're just going to go through. Here's ABT. You can see that it's testing the top of this year's highs. Measured move would suggest almost a 15% breakout if it does to the upside. Another one that looks the same as the AXP, American Express. Similar pattern testing upside highs. And what we're doing, folks, is we have buy alerts set that if we get a breakout to the upside, then you would want to buy this asset and then set the stop just below the top of the ascending triangle. The next one would be ICE, a very similar pattern. And again, these are S&P large 500 stocks. ILG, similar pattern. MRK, similar pattern. Google, similar pattern. Medtronics, MDT, similar pattern. ESGR, similar pattern. Now, for those of you that like the idea of long-term rising trends, but assets that have discounted themselves, they've fallen and then created a pattern. This pattern would be a bullish falling wedge that if you have a breakout to the upside, you'd want to be a buyer on the upside breakout with a stop just below falling resistance. So we're going to quickly go through just a few of those. You can see a breakout test for C is taking place. Long-term trend is up. Bearish falling wedge is taking place. Bullish falling wedge, excuse me, is taking place. Breaks out to the upside, you'd want to be a buyer. Similar case with GS. Similar case with PRU. Similar case with PCAR. Similar case with ALK. Similar case with CFG. And a similar case with ACM. So as I just shared in the beginning, if you want to get the list that we just went through from Rick, we'd be very happy to share it. These are things that we're providing to our members. We have filters and screening systems to find these patterns. Then I put some of my own personal touch to them and share them with membership. If this type of thing would be of interest to you, these type of opportunities, we'd be very humbled to have you be a member. So feel free to email us at services@kimblecharting.com or give Rick a call. So Renee, I finished with my part. I'm glad I didn't hack too much to each of the members. Again, I apologize for the cold that I've got. And Rick, take it away. And thank you, everyone. I hope you have a great day and a great weekend.
Thanks, Chris. I'll just wait till Renee switches over here and pull my screen up. Renee, you see my screen okay?
Yep, I can see your screen and hear you loud and clear.
Great, thank you very much. Well, thanks again, everyone. And incidentally, one or two of those positions, I know Google, you saw one of those ascending triangle breakouts. Google, we are in that position. Our members are in that position long. So the other ones that are going to break out, that's certainly something that we're going to be looking to take action on and suggest our members take positions. So I'll give you an example of that in just a bit. So we're going to talk about how to stay current with our research and a special offer to the first 62 people. And I almost forgot to mention what 62 was about, but Chris will be 62 this year, birthday wise. And so in honor of that, we're going to offer something special for the first 62 folks that want to take advantage of it. So first, how to stay current on the ideas presented today. Research products. Here's how to stay current. There's 3 ways you can basically stay current with our research. First is our individual research reports. Chris does weekly reports on our global trends taking place, sectors and commodities, and also the metals. So 3 separate reports that he does on a weekly basis. Based on your interest, you can subscribe to any of these individually, or you can combine all 3 with a substantial discount, which we'll cover in a minute. And that's called our weekly combo. So individual reports that are bundled together with a discount. And then the other way to stay current is if you have followed Chris for some time and you like what he's doing and want to follow all his research, that's our premium. That's everything that Chris produces. So I want to share with you an example of our most popular research package. Most popular, nothing fancy here. It's just that the people who subscribe to our research the most is our weekly combo package. And part of that is the fact that it's 3 reports, 1 package, and it's $134 a month. But you'll see with these 3 different reports, when we combine them, we offer 1 free. So you're really getting 3 for the price of 2. And again, every week you get these reports. We also produce position and trade alerts, about 4 to 6 on average a month. It really depends on market conditions and the patterns. There could be fewer, there could be more. And focus is on ETFs and occasional individual stocks as far as coverage, position tracking, as you would expect, but we do track the positions for you, and I'll give you an example of that in a minute. And then one-on-one support. If you have questions, I just want you to know that if you email us, we're going to get back to you immediately within the same day or next day. If you need to talk to me directly, we're going to go over that. Premium members, if you're a premium member, we can also offer some one-on-one time with Chris if needed. So we want you to know that you truly have support. And between Chris and I, there's probably around 50 to 60 years of experience in the industry. So I think we can give you some really good support in terms of whatever you need. So occasional premium content is also included, and delayed access to premium webinars. So I think these are the factors, when you add them all up, makes our weekly combo probably the most popular package that we offer and the most subscribed to. So just breaking it down a little bit, who the research helps the most. So I want to break down what's included with weekly combo in breaking down the individual weekly reports. Global trends is really great for people who are looking for a 30,000-foot view of the world and the global indexes. Chris, as you can see with his charts, covers long-term patterns. One of the greatest values of long-term patterns, even if you're a shorter term trader. Now, shorter term, I don't mean day trading, but say a swing trader, or a long-term investor like many of our financial advisors need to be for their clients, is when you see a long-term pattern breaking out, certainly there's potential for much greater upside than if you were looking at a 1-hour chart and there's a breakout. So Chris is going to focus much more on these longer term patterns. And if you're looking for that big picture pattern of the world in the major global indexes, global trends is of great value. And as I said earlier, for those who desire limited trading, like for example, financial advisors or people who simply have restrictions in their plans that don't allow them to trade often, global trends it's an excellent solution. And then when we look at the sector commodity report, sector commodity is great for people who want pattern analysis specifically in sectors and the commodities, along with real-time alerts on breakouts and reversals. And the metals, same idea, people who specifically are interested in the metals, gold, silver, copper, steel, the miners, and a few others. Again, a weekly report, but we also share real-time alerts on breakouts and reversals as well. So these are the three that are part of the weekly combo that you can combine. And here's an example of a trade alert, just so you get an idea of what we provide when we do send an alert out. So an email will come to you directly as soon as action is to be taken. Chris has a chart that he's going to send to you, and in the subject line it'll say taking action. It'll share what the asset is, the stop price, the position size that he suggests. Now, position size is all about how you want to manage risk and your own position sizing based on the assets and the objectives you have. But he'll share what type of position size he's taking and some brief commentary as to why he's taking the position. Now, I say brief in the sense that Chris is not about long dissertations and white papers on why he's taking a position. We leave that to other guys. Fundamental analysis and other factors that you feel might be important, and we are certainly not discounting them, are certainly information that you can get if you feel it's important. We focus on the pattern. So our job is to give you the chart, show you where the pattern is, and the reversal, breakout, or in this case, an opportunity to buy on support in Apple. So this is an example of a trade alert. This is just an example of a position summary, and lots of information we provide. We continue to add to this information that we feel people that would be helpful to people in terms of tracking our positions, and of course, any additional questions that we can help you with, we're here to help if it's not on this report. Sent twice weekly, And also, we do include closed positions for the past 30 days with each update. Just a couple of comments about, I know you probably expect to hear some testimonials from us, but the reason why I want to share these two is just to give you an idea of why people use Chris's research. If we could really break it down into a couple of comments and into a nutshell. It's simple and easy to understand approach, clear information, and results that made the guy money. At the end of the day, these are probably the top 3 things that we really want to try to provide you so you can improve your decision making and your results. Now that comes from an individual investor. Financial advisor, John, he shared that thanks to Chris's research, it helped him get on the top list of Forbes, which is certainly a big surprise. We don't expect to hear that one often, but we're happy that we did. Overall macro view helped him a lot. Ignoring the noise, which is what really chart analysis helps people to do, and some bullet points that he can share with clients to educate and just to get his clients up to speed on what his thinking is, helps him a lot. Okay, so the offer real quick here. Research products run from $67 a month to $397 a month based on what you need and want in our research. Here's our offer. Exclusive offer for the first 62 people, 3 months free added onto any annual subscription. So after subscribing, we're going to add 3 months on to the end of your membership. That's anywhere from 200 hours to 1,200 hours of free research per person that we're adding on. We also offer, with all of our research, a 30-day money-back guarantee. So any research subscription, we guarantee it for 30 days, and in the first 30 days, it doesn't make sense for you, just let us know. And we'll refund your money if you want us to refund your money. So it's a completely risk-free decision. At least that's our goal, so that you can sample the research, make sure it's for you. And here's how you subscribe. There's a link that Renee should have that she can put in the chat box right now that'll take you to where to go to subscribe. And I'm going to give you an example. In this case, if you wanted to subscribe to our most popular research, which is Weekly Combo, you can go to our site, scroll down, and look for Weekly Combo Research. And then you click on Start Weekly Combo. And then when you get to the billing section, you'll see choose an option. You'll choose annual. In this case, $12.97 a year. And then add to cart, and then you check out from there. Pretty straightforward on how to do that. And again, once you've subscribed, I'm going to add the 3 months on right after you subscribe. It's just a technical thing. I have to do it after the fact on the back end, but that's how you'll get the additional 3 months. So 3 months added on any of our research, Weekly Combo in this case, $12.97 with an annual subscription. Just adding it up, it's about $25,000 of free research that we're giving out today to the first 62 subscribers, if in fact everyone wanted to subscribe to the Weekly Combo. But it's all of our research products. Any of our research products, we're going to give you the 3 months. I think I covered this enough. How to do that. If you have any questions, you can call me. Here's our email address. Here's our contact information. Different ways to follow us. And I think that wraps it up. I know today we probably didn't have time for questions, but as you know, you should feel free to email us or call us with any questions that you have, and we'll follow up with you. If you put questions in the question box, we'll certainly follow up with those as well. Thank you very much, folks. I don't know if Chris has anything else to say, but I think we're right at our time, and I'm going to pass it over to you, Chris or Renee.
Hey, good. Thank you, Rick. Thank you, Renee. Hope everyone has a super day. Appreciate the chance to share our ideas.
All right, and thank you guys. And again, make sure you do check out that link. I sent it out in the chat box for anyone who wants to learn more from Kimble.